Wagner here, approximately 1:30 in Honolulu, 6:30 in New York on Friday. Happy Aloha Friday, as we say on the islands. It is December 3rd, 2021, and this is the daily report for gold and silver, our weekend review. Traders, for the first time since November 17th, and that is this green candle, we have had a number of consecutive days with lower closes when you compare it to the open, with the exception of what occurred on Wednesday. However, even though it was a green candle, it closed very, very far off of the high of the day. That's not true today. When we saw market forces take gold higher, up $21.20, and is currently fixed at $1783.90. What is impressive to me is that's just off the high of $1,788. The gains in both gold and silver today occurred with very, very fractional headwinds from a stronger U.S. dollar, 96.175, up approximately 0.02%. Another very interesting aspect in the precious metals markets is, first, palladium outperformed all of the other precious metals in terms of percentage gain, but traders look at the current price of palladium, $1,808, up $36. That is the closest distance we have seen it between the price of gold and the price of palladium in quite some time. Silver gained 1.12%, 25 cents, and is currently fixed at $22.56.5. First in Henkinashi format, then Japanese candlestick format. Very similar action in terms of the patterns we're looking at. You can absolutely see the pivotal point in which we saw a reversal from a bullish trend to a bearish trend. However, we have broken now below the 78% Fib retracement, and realize that this is a much longer data set than we are using for our short-term data set in gold, because that data set begins at this low. And so we can see that in terms of a percentage drawdown, silver has incurred a much steeper price decline. Lastly, we want to convert this into a Japanese candlestick chart to see if there are any candlestick patterns that we can identify. When we look at this, we have a very interesting candle that is almost hammer-esque or hammer-like. And the reason I'm saying that is that there's a couple of criteria for a hammer to be identified. The first criteria is that it has to occur after a defined downtrend. We've absolutely met that. The second criteria is that the tail must be at least 3 times the length of the real body. We can say that we've met that criteria. However, the last criteria has almost been made, and that is that it should be a little bit smaller of a real body. The real body is defined as the difference between the open in the bottom and the close on the top. Nonetheless, this can be identified loosely as a hammer. While we are well aware of the fundamental events that took gold higher today, the question is, did we see any major chart damage or any major chart advances? And what's most interesting is I cannot answer that with a definitive yes or no. And what I'm referring to is the compression triangle that we have been looking at as a key and critical point to close above in order to indicate a potential reversal to the upside. That occurs roughly at 1784. That is just above closing pricing. Also, if you look at the close of today, that matches up quite eloquently to the 78% Fibonacci retracement, and that retracement is of a very short data set, the last leg of this rally, beginning on November the 3rd, concluding November the 16th, taking gold from 1757 to 1879. Even with today's respectable gain, when we look at our weekly chart, we can easily see that it closed slightly below its opening price on Monday and below its closing price last Friday. What I want to draw your attention to is on this chart, you can see a total of 3 Fib retracements. We have spoken about the first one here that starts at 1680 and goes up to 1920. We have talked about the second one, which begins just during the last leg of the rally, 1757 to 1879. But we've also included a very long-term Fib retracement that begins at the highs that occurred August last year, 2088, and concludes at the lows of the flash crash in August when gold traded to 1677. That also matches up with the double bottom that occurred in March. When we do that, we can see and identify what I call a Fibonacci harmonics. A Fibonacci harmonics is simply when two different size data sets allude to the very, very same number, even though one might be a 61.8% retracement in the case of the middle Fibonacci retracement, and then the long one is a 23% retracement, and that, of course, occurs at 1771.50 right here, and this also occurs precisely at that same price point. What does that mean? When you get two different data sets pointing to the same number, it strengthens the validity of that particular price point as having significance. And without a question of a doubt, we have closed above that, and that is the first step for any attempt to find support, consolidate in the bottom. However, it's much too early to say that. We are in a fluid market with events changing day by day and a highly headline-driven financial market. And so for that reason, on a technical basis, we have closed just at 1784. We opened above it, but we closed at it. So that to me is not that significant. What I would like to see is a strong close, a green candle above this price point before I start looking at the potential for a key reversal to the upside. On the reciprocal side, if we see continued pressure, to me that would be defined by a break below 1771.50 on a closing basis. Traders, as you can see, I've converted our weekly back to a daily and converted our candlestick into a Henkin Ashi or Japanese average chart. The key difference between a candlestick and a Japanese average chart is how they fix the open. In a candlestick, it is the true open. In a Japanese average chart, the open is derived by plotting the midpoint of the prior candle. And you can see that here and on any candle. That's how we get the open. Now, what that does is it tends to average or take out the noise within the market. The key to this type of chart is, first, it gives us a lot of information about strength or lack of strength of a particular trend. It can indicate pivot points, points to look for a key reversal, and there's a couple of very, very easy steps to follow in order to understand how to interpret this chart. I draw your attention to this rally that occurred, and what you can see is that we have a lot of large bodied size candles, and that is the first thing that we look for. The second thing that we look for on the way up is the absence of lower wicks, because what that says is that at no point during the trading session did it trade below the midpoint of the prior day. The opposite is true when we're looking at a price decline, because then we're looking for an absence of upper wicks. And if we look at this most recent decline, and it is most interesting, you get your pivotal candle right here. Pivotal candles occur after a strong uptrend or downtrend. You go to very, very small doji-like candles, and then you begin to see that reversal. Take a look at the size of these first couple of candles here. They are very large candles. They all contain the absence of an upper wick. That's telling me there is a lot of selling pressure. But that begins to diminish, because here you have an upper wick, here you have an upper wick, and you in fact have had upper wicks for the last consecutive 5 or 6 trading days. Now, you also have a very small bodied candle here, which tells me it is the potential for a pivot, but there is a large caveat to using this type of chart. And that is because it is, in essence, average-based. It will always lag behind real-time data and therefore tell you where the ship has been and not where it is necessarily going. But still, in terms of being able to judge the strength of a trend, it is my go-to Japanese chart study. This last chart that we are looking at is derived from daily data, and it is called a three-line break chart. It's very analogous to a point and figure chart in Western technical analysis because it omits time and looks at market price change before it draws the next candle or box. And typically on a three-line break chart, you're waiting until three lines in the same direction occur, and then you would wait until a reversal line has formed and enter that in the direction of the reversal. A three-line break chart can be used as an interim to plot the direction of trend. That's the definition right here. Right now, what we are looking at is you have the magenta line, which is indicating its projection, and based on recent activity, it is looking for higher pricing. But then, once again, caution to the wind cannot be avoided. 1785 has to be the number in which gold closes above before we can make any assumption that a pivot has occurred. This has been Gary Wagner wishing you, as always, good trading. We will talk to you on Monday for the next daily update and review. Bye-bye.